exam. Will go as per the priorities of exam. So you want to look at the cost of capital, the cost of capital, the cost of capital. So kusema cost of capital, when you talk of cost of capital, so joint ni sawa. So when we talk of the cost of capital, we are talking about when someone asks you what is a capital. So capital is a fund used to do what? To finance the project, to finance the project, to finance the project. So that's what it's meant by the capital. Or so it is the funds used to finance. It is the funds used to finance the project. The funds used to finance the project, or the money resource which is used to finance the project. So this project, it is even the business itself is the project. Even the business itself is the project. And in finance, we have the main source of capital, which is there are three main sources of capital: the preference shares, the ordinary shares, and the debentures. Those are the main source of fund in business. Those are the main source of funds in business. So tutaangalia hizo tatu: the cost of equity, the cost of debt, and the cost of the retained earning, and the cost of the retained earning. It was just waiting for. So we said that the cost of capital is the fund used to finance the project, to finance the project. Now that is the capital. What about the cost? The cost. So when we talk of the cost, is the investment. These are the what? Or the cost of the capital. So which mean the investors ask to what? Ask to fund this project, ask to fund this project. And who are these investors? Tumesema the investors here are the owners of the ordinary shares, the owners of the preference shares, and also the owners of debenture. So at the end of it, akisema mimi nikitoa 100 million, itapata ngapi at the end of it? So now we need to get the return. So here we are calculating the return of this cost the return of this cost, ama profit. So you can say it is the minimum rate of return. Let's define the cost of capital, the cost of capital. So let's define the cost of capital and say it is the minimum rate of return. It is the minimum rate of return required by providers of, you can put semicolon, the preference shares, which you can write but unaweza andika in full, the preference shares, comma, ordinary shares, and debentures, So it is the minimum rate of return required by the providers of the preference shares, ordinary shares, and debenture. So the main concern here is the rate of return. So before you look at the rate of return, or before these shareholders decided to invest Umeipata that definition? Nilikuwa nimeona amesema but don't. So it is the minimum rate of return required by the providers of preference shares, the ordinary shares, and the debentures. So before now they invest in your business, they have to look at some of the factors. So we have the factors. So you can write factors that influence, factors that influence the firm cost of capital, the firm cost of capital, the factors that influence the firm cost of capital. So we have factors which influence the firm cost of capital. Number one factor is the component cost. Number one factor is the component cost. The component cost. So this component cost is the preference shares, ordinary shares, and the debenture. So the higher the cost of capital, also the higher the component cost. So you can say for this one, the higher the component cost, the higher the component cost, comma, the higher the cost of capital, the cost of capital. So the higher the component cost, the higher the cost of capital. So tumesema the component cost ni hizi tatu: preference shares, ordinary shares, and the debenture. Another factor, number two, is the tax rate. So there also goes the zote zinakuwa like the ziko too proportionate. So the higher the taxes tends to use more debt. The higher the taxes tend to use more debt. The higher the taxes tend to use more debt. Then I will ask a question. The higher the taxes tend to use more debt. Tends to use more debt. I know you have done taxation. Why is it that the people who have debt, they tend to use the debenture instead of the preference shares or the ordinary shares? Yes, Sharon, you are a financial what do we call a financial officer, or the chief officer of ABC company. You have been invited to the bank, maybe the bank of the company, and you are among the client company, and the bank wants to give you a credit note. Will you advise the owners of the company to take the loan, the higher loan, or you advise the company not to take the loan? Utapeana advice gani as an accountant? Wachana na zile tu normal advice. Hey, chukua loan. Loan itasaidia kampuni kuleta in terms of cash flow. Which other advice will you give as an accountant? Sioni any comment. So if we are to explain that the companies which they have more debt, they tend to use more debenture compared to the other preference shares. For example, I will give you a scenario here. I will give you a scenario of A company and B company. So I have two scenario here. So juu natumia microphone, tunaweza communicate through the chat. I will be able to get it. So we have two companies here, A and B. We have what is called the profit before tax, which is a good example. I can't use 200, and that here also the profit before tax is 200. This one is the profit before interest and tax. We call it pivot. I think you have done it in taxes. And then what do? We less the interest on finance cost. That is, the interest is coming from the debenture. This one, we have an interest of 10, assuming these are in million or in thousand. No. So This one is a levered, we can say this is a levered farm, the levered farm. And this one is unlevered farm, unlevered farm. So ukifika advanced level utachua hizi terms. When we say levered farm is the company iko na debt na ingine haina debt. So hii iko na debt will charge an interest of 10 shilling. This one will not charge an interest. This one will not charge an interest. So that we arrive here at the profit. We arrive at the profit before tax, which this one itakuwa 190. This one will be 200. Less tax of what? 30%. Less tax of 30%. 30% of 190. Let me take my calculator. 30% of 190, we getting 57 shilling. 57, subtract 57. 30% of 200, this one we are getting 60. So if you get this one profit after tax, this one will be 190. 190 minus 57. This one will get 33. And then this one will get what? 200 minus 60. This one will get 140. This one will get 140. That one will get 140. That one will get 140. So you can see the different. There's two different here. There's two different here. We are gonna, but in terms of profit is that you can see this one at the end of it atakuwa na more profit. That is the profit before tax. But we are not advising the client here on terms of what? The profit before tax. So if you are to advise client achukue loan ama asichukue loan, unaangalia this perspective, the saving. So unaangalia the saving client atamake, the saving. So client B will pay more taxes, which is 60 compared to a client A. Client A will pay less taxes. He will pay 57 shilling, but this one will pay 60 shilling because of what? Because of interest. Because of interest. So if you use more debt, you will save tax compared to the farm which is not using any loan. So that is the advice ungepeana as a professional accountant, So we look at another factor which is so kuna so many explanation there which inaitwa the tax saving shield. So this one we call it the tax saving shield. The tax saving shield. So you can try to that one hapo chini, but it is not necessary. So number 4, the fourth factor is the availability of assets. Availability, number 4, or number 3. Availability of assets to pledge. Availability of assets pledge. So tunaweza explain that one, say a company that has collateral, a company that has a collateral, may easily use debt. A company that has a collateral may easily use debt. To finance its operation. Operation. May easily use debt to finance its operation. May usually use debt to finance operation. The fourth factor, number 4. Number 4. Number 4. Number 4, you said quotation at Nairobi stock market. Number 4, quotation at Nairobi Security Exchange or the stock market. The stock market. So a company which is being listed in Nairobi Security Exchange, they can easily raise funds because most of the public wanna believe hii kampuni inafanya vizuri because of what? There's no one investor there. We have several investors because people can buy shares in Nairobi Security Exchange and they can be the shareholders of the company. So this company, most of the time they finance their operations through ordinary shares because people wananunua shares. So they finance their operation through the ordinary shares. So you see a company that is listed or whose securities are security can easily raise additional capital. Can't explain and say a company that is listed in a stock market can easily raise additional fund through issue of ordinary shares to the public, So they can easily raise the ordinary shares or the additional capital through the ordinary shares from the public. So utapata companies like Safaricom, when they want to issue the additional share capital, they issue what is called the IPO to the public. So the IPO, it shows that the number of shares the Safaricom are willing to sell to the public at what market price. So that's what is in the IPO. IPO, it is called initial public offer. I know you guys, you don't have the shares in other companies. So try to start buying shares from these small companies. That saving ya 10,000 unaeka kwa M-Shwari will not save you. This 10,000 unaeka kwa M-Shwari ama unaacha kwa KCB Bank. Kama unatumia KCB Bank sija kusema, but I'm just guessing. This 10,000 will not help you. Reason is, with the current inflation, if you put this 10,000 in your bank account for 6 months, and then you will go there, withdraw that 10,000 after 6 months with the same value, and then tutapata the mkate saizi inauzwa around 65 or 62 shilling. So that after 10 years ama 6 months, hii mkate itakuwa inauzwa 60, itakuwa inauzwa 72 shilling. Now there is an inflation may increase na 12 shillings, and you are still having the same value of what? Of 10,000. So you can see your cash iko 10,000 but it may decrease in value because kitu yenye una afford at the moment ya 60 uta afford na ngapi? Na 72 shillings. So it means your value itakuwa reduce. So instead you can buy shares with these 10,000. So unapata Safaricom, they are selling at 25 shilling MPS. That is the market price per share. Then to find that maybe after 10 years or 3 years, this IPS will, this market price per share will be selling at 35 market price per share. So in one share, you have a profit of 10 shilling. One share, you have a profit of 10 shilling. So also, ukisoma accounts, you also need to be a financial literacy of financial literacy skills as an accountant. Huwezi pata knowledge zingine kwa any courses inakufundisha mambo na financial literacy. Now, tukishamalizana na factors, tunaangalia the component. the component of cost of capital, the component of cost of capital, the component of cost of capital, unless kuna swali. So kama kuna swali unaandika hapo kwa comment section. So can start with the first one. Leo mkono haitaki kuandika. The cost of preference shares. So we can start with the first one, the cost of preference shares. We said it is the minimum rate of return, minimum rate of return, minimum rate of return required by providers of ordinary shares. So it is the minimum rate of return required by ordinary shares or the equity, ordinary shares or the equity. So in this case, you say it is a sticky kupeana a lot of literature. So that is enough. So now we have two methods of calculating the KE. Even though tungecover hiyo kwa valuation, but nimesema siwezi maliza valuation of ordinary shares because huku ndio tutaipata hizo concept kwa cost of capital. That's why nimeskip the valuation of ordinary shares. So iko hapa. Hiyo valuation of ordinary shares iko hapa. So you said there are two methods for calculating KE. There are two methods of calculating KE, or the KE is the cost of ordinary shares, is the cost of ordinary shares. Number one is the Gordon dividends growth model. Gordon dividend growth model. So hiyo tuliandika kwa valuation but hatukuangalia illustration. Goes najua iko hapa. And then number two is the capital pricing model. Capital pricing model in bracket CAPM. Capital pricing model in bracket CAPM. In bracket CAPM. Bracket CAPM. So we can start with the Gordon. Hatuta derive formula. Hatuna time ya kuderive the formula. So we go straight away and look at how to calculate the KE. So the KE stand for the cost of equity. The cost of equity or the preference shares, which you will take. So we have two ways. So we'll start with the DI over PO, DI over PO plus G. So that is the formula. PO or DO into 1 plus G. We divide by PO. Minus F minus G, or not G, D minus D plus G. So those are the two formulas which we use to calculate the cost of equity. So you say where DI represent the expected dividend. DO represent the current stroke just paid stroke for the year. dividend struck for the year, dividend struck for the year, dividend. And then G, PO is the market value, market value. F is the flotation cost, flotation cost. G is the growth. Unajua growth rate. G is the growth rate. G is the growth rate. We have the flotation cost. So bona ingine zijaeka F, E, D is a discount. So D is discount. D represent the discount. D represent the discount. The reason why ingine zijaeka, but they are all the same. F and D. Remember, when you are doing the cost of capital for a company, we have what is called the retained earning, the retained earnings, and ordinary shares. We have the retained earning and ordinary shares. Umekuwa kwa biashara, last month uka make 10,000 or 10 million. Out of this 10 million, ukatoa expenditure, rent, salaries, nini zote, ukabaki na ngapi? Na 5 million. So hiyo 5 million iko kwa bank yenye uli make last year. So hiyo 5 million is what we call the retained earning. So you have done financial accounting, is what is called the retained earning. So instead of you going to the bank or the public to source any other capital, unasema hapana, sitaendea another 5 million, wacha kwanza nitumie yenye niko nayo. So that's what tunasema the retained earning. So hii yenye uko nayo huwezi source from the public, huwezi source from the bank. That's why you will not incur anything here. You will not incur the flotation cost, and also you will not incur any discount. You will not incur any discount because it is from the what? From the within the business. That's what tunasema retained earning. But ordinary shares, unaweza source from the public, which will incur the flotation cost. Flotation cost is very simple term. The flotation cost is the cost of what? Drafting, the cost of drafting the IPO, that is the initial public offer. The cost of what? Kuna legal fees, kuna legal fee, even kuna advertisement ama marketing fee. So those are all the flotation costs, which will affect the market value. It will affect the market value. So tutaangalia all the components, and then from there we look at one illustration yenye iko na zote. So let's go to the cost of preference shares. The cost of hizi zote umeandika? Umeziandika hizi? Okay. Good. So we can go to the cost of preference shares. Cost of preference shares. FOF is a very easy unit. FOF is a very easy unit. Si lazima ukae the whole day ukikram this one, hapana. So it is the only you get small concept and formula. Hapo umesha toboa FOF. So tuko na cost of preference shares. So rudia the same definition. Rudia the same definition to preference ordinary shares. And then only you change the required by preference shares. So it is the same minimum rate of return. Minimum rate of return required by providers of a preference shares of preference shares. So it is the minimum rate of return required by preference shares. So the formula or the simple term of writing the preference shares, we call it KB. That is the simple term of the cost of preference preference shares. So how do we get this cost of preference shares? You take the preference dividend, which tulifanya equal tupigane hiyo valuation of shares. Preference dividend we divide by the PO, which is the market value. Divide by the market value. So that is it for the preference shares. So also if we have the coupon rate, the flotation cost, we will subtract down there. And then we have the cost of debt, the cost of debt, and then you say minimum rate of return, required by providers of preference or debentures and then so say in calculating KD, so this one tuna shortcut ya debentures ni KD. Shortcut of debentures ni KD. So say in calculating KD, the cost of debenture, bonds are categorized into two, bonds are categorized into two. They are categorized into two. That is, bonds are categorized into two. So we have what is called number one, redeemable bond, and irredeemable bond. I hope you can recall, niliwaambia hizi topics za FOF zinakuwa ziko connected. Time value of money iko connected na valuation bond. Valuation iko connected na cost of capital. So you can see we are repeating the same concept. We are repeating the same concept. We are repeating the same concept. Just a minute. So, and continue. So tumesema we have a redeemable and irredeemable bond. So we can start redeemable. So redeemable tulisema ni gani? Is the one which we can't redeem at a given time. Or we can start with the redeemable. Redeemable ni ile yenye uwezi redeem. Inakaa tu ukipea kampuni ama ukibuy shares kwa which circles. So make sure anytime ukiangalia shares kwa circles, you have to ask yourself, which type of shares am I buying in these companies, or which types of ownership am I? So that tujue uko kwa ownership ya preference shares, uko ownership ya debentures ama gani. Usiende tu ukanunua shares kwa any circle without knowing this. So we can look at the irredeemable bonds. Irredeemable bonds. Now, irredeemable bonds is that the one which we cannot redeem. So it is the bond which we cannot redeem. So you can't, we know the definition iko kwa valuation. So this one, it does not have maturity in simple term. It does not mature. This one is mature. So how do we calculate this one now? So hata kama ukumbuki hii, but tunakumbuka how to get the market value of irredeemable bond. Acha nione kama cannot here. Si nimeshaweka. Unanisikia? Catherine, am I audible sahi? Are you able to hear me? Yes? So kindly respond ndo tuendelee. Nimeona umesema I can't hear you. Iko sawa ama ni your phone ilikuwa na challenge? Sharon, unanisikiza? Okay. Now, Sharon, I want to see kama tunasoma ama hatusomi. How do we get the market value of redeemable bond? How do we get the market value of the redeemable bond? Catherine, give us the formula of getting the market value of irredeemable bond. Bado, so make sure ama umemute, check your mic kama umemute. Juu Sharon amesema ananisikia, which mean the challenge iko on your side. So check hiyo setting hapo chini kama umemute. Or you can't exit the meeting and join again. So we said the formula of getting the market value equals to the what? The interest we divide by the cost of debt, which is KD, the cost of debt, which is KD. I didn't want to go the long way, but I want to show you, if you can remember how to get the market value, you can easily know how to get the cost of what? Irredeemable bond, the cost of the redeemable bond. You can make this one the subject. Just make this one the subject by, you cross multiply, which will be KD multiplied by MV, you divide by I. I stand for the interest. I stand for the interest. And then what do? Divide by the market value, divide by the market value. So you will remain with KD equals to the interest over the market value. So this is how to calculate the cost of irredeemable bond. This is the method of calculating the irredeemable bond. Irredeemable bond. Now we have another one, irredeemable. This is irredeemable. So tuko na redeemable. Tuko na redeemable. So irredeemable is the one which you can redeem anytime. So this one you can say it has maturity period. It has the maturity period. It has the maturity period. It has the maturity period. So this maturity period, it can be 10 years. It can be 5 years. We don't know. So it has the maturity period. And how do we calculate this? Kama it has the maturity period, then we have something called yield to maturity, yield to maturity, which in bracket we call it YTM. That is yield to maturity, because it can mature in 10 years, 5 years, 5 months, and then after that una redeem. Kampuni itakurudisha your loan yenye umepea kampuni na interest. That's what is called the yield to maturity. So how do we calculate yield to maturity? So that so yield to maturity, we calculate yield to maturity YTM equals to the YTM equals to the interest plus unaeka 1, you divide by n into the face value, which we are face value minus the PV. Hizi tulifanya kwa valuation, tukasema what is the PV and VV, or the face value or the fair value. We said you need to define what is the book value and the fair value. Tulifanya kwa concept of valuation. So go back to that concept of valuation and look at, we divide by half into this one, una change E, FE plus PV. So that is the formula of getting yield to maturity. So once ukishapata hiyo formula of getting yield to maturity, then remember bond. Hii ni bond. Kwa sawa? Hizi zote ni bond. Na tulisema if you are financing your activities through the debentures, you must pay tax. Or hizi iko na tax allowable. It is tax allowable. That's why tulikuwa tuna subtract interest. Mulifanya tax na nyinyi mngekuwa good advisors wangu wa tax consultant. We said interest expense is tax allowable. So it is tax allowable. So interest is tax allowable. So we have to introduce the tax here. So once ukishapata E, you multiply by 1 minus T. Even this one you multiply by 1 minus T. Hii ni tax. So kama ni 30%, 100 minus 30%. Hii ni 1. So obviously itakuwa 70%. You multiply by 70%. You multiply by 70%. Now, so kuna some of the notes you need to take, like write the note. That's why nilikuambia the topic, hizi topic zote tatu zinakuanga connected. So usiseme ile topic sikuielewa sana, niachane nayo. Hapana. You have to understand all of them because zinaenda iko na the same connectivity. So what is the power value? I don't want to ask you more questions. Najua mmechoka. Now you don't remember mahali uliandikia power value. So in the power value, we define it in the valuation of bonds. We said power value is the what? Is the original cost, is the original cost, or price is the original cost or price. So now you have an NP here, and then you say kwa NB, in case the bond are issued, in case the bond are issued at par value, in case the bond are issued at par value, underline that par value, with no flotation, comma, discount, with no flotation, discount, comma, you said for both redeemable and irredeemable, for both redeemable and irredeemable, and irredeemable for both redeemable and irredeemable before tax, before tax, comma, the cost of debt equals to coupon rate. The cost of debt equals to coupon rate. Na bado unakumbuka what we said. Ukiambiwa 10% debenture, 10% debenture of 10 million. I normally kila siku naandikanga hii value. So hii ni coupon rate. This is what we refer as the coupon rate. So ukiona examiner amekuambia these bonds are issued at par. These bonds are issued at par. Don't stress yourself calculating the cost of debt. The cost of debt will be same as 10%. So just give that 10%. Just give that 10% because if you calculate using this one, still you will get the same results. You will get the same result. Hata kama ni 5%, 2%, 20%, unaandikia hiyo percent. But tumeambiwa before tax. So you have to be keen. So whatever you are getting here, if it is 10%, you will just take that 10%. Utachukua hiyo 10%, you do what? You will take that 10%, you multiply by the tax rate, you multiply by tax rate, you get your cost of debt. You get your cost of debt. So that is all about the component cost in terms of theory side. Kuna ingine vitu zingine inaitwa WOCACA, weighted cost of capital, but lazima tufanye illustration before tuangalie hiyo. So unless kuna swali ama hujasikia wapi? Determine the cost of capital for business activity. Yeah. So if you look at your syllabus, here I like inatakikana. So ukiangalia determination of cost of capital for business entity, the examiner ama as per your syllabus inataka uangalie the relevant cost of capital to the firm, which tumeshasema, the usage, which the uses is just to finance the business activities, and then factors influencing the firm's cost of capital, umeandika around 5, so make sure utaelewa hizo, and then tukasema component of the cost of capital, debt, ordinary shares, preference shares. So mpaka hapo tumefika hapo, so tumebakisha nini? The firm overall cost of capital, which tuko na weighted average cost of capital and weighted marginal cost of capital, na tuko na limitation of weighted average cost of capital. So hata hii topic tunaweza maliza leo. Tulianza class 9:30, so tunamaliza 10:30. So we can finish this topic today. Now, so we have done with the component cost. Let's look at the illustration. Itaenda, I will not go to the hizi zenye ziko na choices, nataka iko complete. I want yenye iko complete so that we cover everything. Hizi zenye ziko na choices tunaweza fanya bado, but nataka iko na complete, iko na hizi all the components. That one will be easy for us to understand all these concepts. I want yenye iko na all the components. So kindly, kama umeona yenye iko na all the components, unaweza niambia ni gani? Hizi ziko na 1 mark, 1 mark, 1 mark, 1 mark. There is a one which is good one. I can't give you to this one as an assignment. So niandikie August 2023. I will give you that one as an assignment. August 2023, question 1C. August 2023, question 1C. So that one chitakupea as an assignment. Na kuna assignment ilipeana but sioni mtu akituma. Ama hamuna time ya kurevise. Make sure una sacrifice at least 1 hour. Sometime haufai kuwa loyal sana na huyo employer. Even though ana provide what they provide at the moment, sometime you have to get yourself time, because once ukishamalizana na hizi vitu, then you will have now more time to provide service for them at a higher price even compared to what zenye una charge saizi. So you can't be able to demand for the salary wages, because now you will be a CPK, so you can demand for a salary increase. And remember, hauisomi tena, so now you are the full-time service provider. So that's why zote ziko more benefit, like employment is good, and also these courses is good also. So we have now an illustration here, April 2023 illustration. April 2023 question kwani zote ni C, question 1C. April 2023 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 question 1C. So tuitafute hiyo. Tumeipata? Tuko hapo kila mtu? Sioni respond. Usingizi imekuja. So make sure at least una chat hapo so that ukue active, zipate usingizi inakuja haraka haraka. So that April 2023 question C, we have been told the capital structure of Mabato Limited is as follows. So you have to be different, the capital structure. So underline the word capital structure. So that capital structure, so underline the word capital structure. So there is a reason why nakwambia underline that word capital structure. Is as follows. So we have the ordinary share capital, in bracket the par value of 10 shilling each, at the total value is 40 million. We have 14 preference share capital, par value of 10 each, of the total value of 20 million. 20% debenture of 6 million, 16% long-term loan at 10 million. Additional information, you have been told ordinary shares are currently trading at 15 shilling on the security markets. Okay. The company has paid dividend. The company has paid. Underline the word the company has paid. So underline the word has paid. Hapo ndio watu waangukanga FM. FM is very easy, but because of small mistake, People fail this finance. Underline the word as paid. As paid. Underline the word as paid. Underline the word as paid. The dividends are expected to grow at the rate of 40% for the foreseeable future. And the 10-20% debenture have a par value of 1,000. The market price of the debenture is currently trading at 950 shillings. The debenture have a maturity of 10 years. The preference shares are currently trading at 14 per share, and the company tax rate is 30% required. Number one, the cost of the ordinary share capital. Number two, the cost of preference share capital. Number three, the cost of debenture, the cost of the long-term loan in bracket after tax, and the one which you have not covered, the company's market weighted average cost of capital. The company weighted average cost of capital. So niandikie hapo component cost. So how many component costs do we have here? We have the preference shares, the ordinary shares, and the debenture and loan. So andika component cost. Component cost. So the component cost number one is the KE, the cost of ordinary shares. So the first component is the KE. So tulisema in finance, before even you start answering that question, write the formula. This one we said, now that is the question. That's one nilikwambia, underline the word as paid. Which formula are we using? Which formula are we using? Which formula are we using? Tumeandika two formulas. Which formula are we using?
The first one.
Sharon, tunaona unaongea but I can't hear you. So you can chat. Ama Zoom yako haina chat option, you can unblock. And then so which formula are we using? Ukiangalia hizo formulas mbili za KE, tumesema kuna DI and DO. Kuna DI and DO. This one we said it is the current stroke just paid, ama kizungu imechange. We can say as paid, and for the year. So that's why that word just paid or as paid inakusaidia kuidentify ni formula gani tunatumia. So that word peke yake as paid will help us to identify which formula are we going to use. So tutatumia DO into 1 plus G over PO plus G. Hatujaona flotation cost. So we will not introduce the flotation cost here. It is not a must that you introduce the flotation cost if there is no. So this is the formula we are going to use. So DO, which is the dividend just paid, we have been given there, number 2. The company has paid a dividend of 2 shilling per share. So we have 2 into 1 plus G. G kwa wapi? The dividend are expected to grow at the rate of 40%. So plus 40%, we divide by the market price per share, which is number 1. Ordinary shares are currently trading at 15 on the security market. So that is the PO. So the PO is 15 plus our G, which is 40%, which is 40%. So if you convert this, it will be 2 into 1.24. We divide by 15 plus 0.4. 0.4. So get that one. Hiyo ni rahisi. So hizo ni 1 marks ama ni 2 marks for free. So 2 times 1.4, we divide by 15 plus 0.4. So we are getting 0.5 times 100. Remember, these are the cost of the return, which is in terms of percentage. So we have to multiply by 100. So if you multiply by, is it that you're getting percentage? Or yeah, it is hard because the cost of return is 10%, is 40%. So we have 1.4 or 1.104 times 2. We divide by 15 plus 0.4 times 100. So there is a lot. Hii ni kubwa sana. But since we have been given the value, 7%. So that is the cost of ordinary shares. So the cost is higher here, but you can see the growth. Growth tumeambiwa 40%. That is a big G. So that is the value of cost of ordinary shares. You have 2 marks there. And then number 2 is the KB, the cost of preference, which tumesema you take the preference dividend, you divide by the market value or the PO. You divide by the market value or the PO. We said from the valuation topic, we said for us to get the preference dividend, you take the coupon rate times the par value, times the par value of the preference shares. So in this case, ni note gani tumepewa ya preference shares? Number 4, the preference shares are currently trading at 14 shilling per share. So that is the PO. So our PO tumepewa 14. They are currently trading at 14%. So you have been given 14%. And then the par value. Hapo chini hatujapewa par value, but ukiangalia huko juu tumepewa par value of each of 10 shares is 10. So, but it is not 10 here. So it is 14. See, tumezoea 10. So we are 14% of 10 shilling. The par value is 10. So 14% of 10 shilling. Whatever you are getting here, multiply by 100. So it will be 14% times 10, which is 1.4. We divide by 14 times 100. So we are getting the cost of debt, the cost of preference share here being 10%. Being 10%. The cost of preference being 10%. That is number 2. Number 3 is the cost of debenture. KD tumesema. So unaangalia hii KD. Moja akitoka mwingine anaingia. So is there any a network problem? So let's give a minute. Tuone. So make sure ukitoka unaingia immediately so that we proceed. So ukikuja KD, ulisema unaangalia the nature of the bond. So what is the nature of the bond? The debenture have a maturity of 10 years. So the nature of the bond here is redeemable bond. So examiner atakumix na zote mbili. Examiner atakumix na zote mbili. But unaangalia the nature of the bond. So the nature of the bond here is the redeemable bond. So if it is the redeemable bond, then our formula will be what? We will be using YTM. YTM, and then we multiply by the tax rate. We'll be using the YTM, and then we multiply by the tax rate. You umeshaandika? Umeshaandika hizi? Okay. So you can craft that. So I don't know. Shona tarudi ama ameenda sapa. So we go to the YTM. So let's calculate the YTM. Then after that, we will do what? We will multiply by the tax rate. We will multiply by the tax rate. we multiply by the tax rate. Multiply by the tax rate. So tumesema YTM. How do we calculate the YTM? We say the interest plus 1 over n. We take the face value minus the book value. We divide by half over face value plus the book value. So that's how to calculate the YTM. So let's get the interest. The interest will be, they will be given the coupon rate ya ngapi? Debenture ni 20%. So the interest will be 20% of the par value. The par value of that bond, tumepewa wapi? The 20% debenture have a par value of 1,000 shillings. So the par value of that bond is 1,000, which will be able to give us the interest plus 1 over n, the number of years. Hii tumeambiwa ina mature after 10 years. So we divide by 10 into the face value. The face value is different na market na BV. That's why tuliandika hizo concept kwa valuation bond. Tulisema hii ni fair value. The fair value is the value which they are currently selling at the market. But PV is the original price. So in this case, 1,000 here is the original price because this 1,000 is what? Is the par value. So 1,000 here is the par value. 1,000 here is the par value. But now, so you can interchange because if you can see the debenture are currently selling at 9,000. So we can go as per the examiner. So you can interchange it because if you use this one, you will get a negative and there is no negative cost of capital. So you can interchange this one. We take 1,000 minus the par value, which is 950. And then we divide by half, which is 1 over 2 into 1,000 plus 950. So this one will be able to get the YTM. So this one will be able to get the YTM, which so there are other books which zingine inasema from the book value minus the face value, another one. So they interchange. So now unaenda na examiner values. Unaangalia ni gani zina make sense with the examiner value. So we'll have 1,000 minus 950, which we get 50. 50 we divide by 10, which we get 5. 5 times 20% of this, ingapi? 20% of 1,000, we get 200. 200 times 200 plus 5. 200 plus 5, which we get 205. So huku juu tunapata 205. So kindly confirm you are getting with me these values. 205. And then the other one is 1,000. 1,000 plus 950. We divide by 2, which we get 975. So divide 205 minus, we divide by 975. We get 0.222 something. This one is before tax. That one is before tax. We multiply by tax, which is 0. We multiply. So this one I'm getting, you can round off to 4 decimal place, 0.21003. This one is before tax. So multiply by 1 minus 0.3, which it will be 0.2103. We multiply by 0.7. So we will get, so time 0.7, which is 14. I'm getting 0.4 multiplied by 100, which will give us 14.7%. 14.7%. So that is the cost of debenture. That is the cost of debenture. That is the cost of debenture. Naona hii mko na bahati. Naona laptop. Kwani tumemaliza 2 hours? Okay. Kuna swali hapo? Ni gani hujafanya? Katri, ni gani hujafanya? Roman 1. So Roman 1 ni gani? Cost of ordinary shares. So wacha nimalize zote and then tuangalie ni gani mtu hajapata, then we'll repeat that one. So we go to the last one, the cost of long-term loan. The cost of long-term loan. Long-term loan inatumia tu another term, but ni the same na hii. But now this one, remember loan, we cannot redeem this one. Ukiangalia the nature of the loan, we don't redeem. So it will be KD equals to the interest. We divide by the market value. We multiply by the tax. We multiply the tax rate. So the interest for this, the loan, tumepewa 10% long-term loan. So tumepewa 16% long-term loan times the par value. The par value of these long-term loans tumepewa iko wapi? Iko wapi the note ya long-term loan? The long-term loan iko. This was a good examiner. The value of long-term, there is no any other information which is talking about the long-term loan. So what is our, yes, so Catherine, I will explain that one. So what is the value of KD here, or the long-term loan? So the examiner here is silent. Examiner has not provided you the book value or the fair value or the market value of the loan. They have not given you the market value of the loan, or they have not given you the par value of the loan. So in that case, examiner is telling you that the cost of this long-term loan is equivalent to the what? To the coupon rate before tax. Ile NB nilikuandikia. So the cost of debt is equivalent to 16%, 16%, because we have not been given any information. But now this one is before tax. So we multiply by 1 minus 0.3, which will be 16%. We multiply by 0.7, by 0.7. So itakuwa 16, we multiply by 0.7, which we get 11.2%, 11.2%. So you can see that's where most of the people, they fail FM or the finance because of those small notes. FM is very easy, but if you don't take into account those small adjustments, then utakotoka kwa exam room ukisema that paper is very easy. So make sure that you are noting those small adjustments. Now, Catherine, umesema haukujua number Roman 1, the cost of ordinary shares. So we said the cost of ordinary shares, the cost of ordinary shares KE tunachukua DO into 1 plus G over PO plus G. The reason why tumesema tunatumia hii formula iko na DO, reason is tumeambiwa dividend as paid, or the dividend has been paid. So ukisema as paid inamaanisha these are the current dividend, not expected. These are the current dividend, not expected. That's why tunatumia hii formula ya DO, atutumii DI. Examiner angekuambia hapo chini iko wapi? The dividend ingekuambia the company the expected dividend as is 2 shilling, then tungetumia DI, but tumeambiwa the company has paid a dividend of 2 shilling per share. So which means we will use the second formula, this one. So which will be 2 into 1 plus G, the 40%. Our growth rate is 40%, which if you divide by 100, it will be 0.4 into P, the market price per share, equal number 1. The ordinary shares are currently selling at 15 shilling on the security market. So that will be the PO, which is 15 plus G. G is the same nai, which will be 0.4. So if you get this one, will be 2.8. You multiply this time, this plus this times this, get 2.8 divided by 15 plus 0.4. Whatever you are getting here, multiply by 100%. So which will be Tulikuwa tumepata 58 point something. Ilikuwa 58.67. Sijaisahau 58.67. Kuna swali lingine? So number 5, the weighted market average cost of capital. The first step is to compute the component cost. So already tumeshamalizana the first step, ndio tukiangalia the market weighted average cost of capital. So the first step is to compute the component cost. Once you have computed the component cost, then we can do the weighted average cost of capital. That's why nimekuambia hii topic tunaweza maliza leo. Kama singekuwa naona kamera ina blink blink hapo. So let's see if we can introduce that weighted, ndio tupate hii kamera ituzimie ikiwa katikati. Yes, so you can write weighted average cost of capital. Weighted average cost of capital. So don't hope umeandika hizi values zote juu nitaitisha hizo values. So andika weighted cost of capital in bracket WACC. In bracket WACC, and then you say it is the combined cost of existing fund. It is the combined cost of existing fund. It is the combined cost of the existing fund. It is the combined cost of the existing fund by the company, or use or by the company. Zungu ijaenda vizuri hapo. By the company to undertake existing project, to undertake existing project, to undertake existing project, to undertake the existing project. So when we say it, existing cost, we are talking of that is the KE, comma, KB and KD. So these are the components of the existing cost. So the company uses the existing cost to finance the existing project. Finance the existing project. So steps, niandikie steps. Steps. Steps of calculating worker count. Steps of calculating worker count. Number 1, calculate the component cost, which we have done that. Number 1, calculate the component cost. Number 2, calculate the weights. Calculate the weights. Calculate the weights. So hizo ni steps 2 mbili. Number 1, calculate the component cost. Number 2, calculate the weights. Calculate the weights. We can't finish that topic. So we have already calculated the component cost. So let's calculate the weights. Let's calculate the weights. Let's calculate the weights. So to calculate the weights of capital structure. To calculate the weight of capital structure. Na yake imeenda kabisa. Yes, so we said you have to do the weight of the capital structure. So the weight is very simple. Ukiangalia tumeshapewa already the capital structure there. So utaandika hapa KE amount is just copy pasting that KE mepewa amount that is now if the examiner is silent, we're going to use what is called the market value. So ukiangalia hiyo 40 million ama 40,000 tumetumia the book value, but we want to change to the what? Market weighted average cost. So tutatumia market. So tutachukua 40,000, we divide by 10, multiply by the market price per share, which is 15. This one will give us the value in market value. In the market value. Hizo zenye ziko hapo ni original cost. So tunataka kutumia market. So 40,000 we divide by 10 times 15. So we will get this one to being 60,000. And then we go to the second component, 14% or KB. KB wako na ngapi? 20,000 we divide by 10. 20,000 we divide by 10, multiply by the market price, which is 14 shilling. Multiply by the market price, which is 14 shilling. So 20,000 we divide by 10, which we get 2,000 times 14. We get 28,000. KD, we have been also given to the par value. The par value is 1,000. And so you will get the total value there, 6,000. 6,000, you divide by 1,000, we multiply by 950. That is the market price is 950. So we'll get 1,000 with 6,000. We divide by 1,000. We multiply by 950. We get 7,000. And then our loan tuna issue at par. So that one will not change. So we will just take the value at it is, which is 10. So get the total of this. Get the total of this, which will be able to give us the weights. Be able to give us the weight. So the total of this is 60 plus 20, 28, sorry, plus 7.5 plus 10. So time is 1,000. So the total of this is 103. So kindly confirm with me these figures. So the total of that is 103,700. So for us to get the weights, I will take this, I divide by this. So the first weight will be 6,000, 60,000. I divide by 103,700, which will give me the first weight, which is 60,000. I divide by answer. So the first weight will be 0.7. So make sure round off 0.78. So this one will be 58. The second one is 28,000. We divide by 103,700. If you round off, this one will be 0.27. Then what about this one? 5,700. We divide by 103,700. We get 0.05. And then what about this? 10,000. We divide by 103,700. Make sure inakuja round ini. If you round off 0.01, this one should give you exactly 1. Should give you exactly 1. That one will give you exactly 1. So I think Sharon umeingia. Umesema tumesha introduce the WACC, the weighted average cost of capital. Tumesha introduce the WACC, the weighted average cost of capital. Na tumesema the definition you can write the WACC is that the company uses existing. This one to be defined as the company uses existing combined cost to finance the existing project, So tumesema the company uses the combined cost or existing combined cost finance the existing project. And then we have said there are steps of calculating the WACC. Number 1 is calculate the component cost, which we have done that. Number 2 is to calculate the weight, which hiyo weight ndio tumecalculate hapa. So tumesema to calculate the weight, unaangalia hapo chini. If the examiner is silent, unless examiner akwambie use the book value. But examiner here is silent. Amesema the company market weighted average cost of capital, which mean you have to use the market price per shares. Ukiangalia hapo juu. So, okay. So I will, umesema 28,000 ama 14,000. So tutafika hapo. Catherine. So tumesema the company uses the the market value. So ukiangalia the capital structure yenye nilikwambia underline 40,000, 20,000, 6,000, 10,000, those are the book value, or multiply the book value, which is the par value. Par value is the same as the book value. So we have to change that one to use the market value. So first, we have to get the number of shares. Ukiangalia hapa nimechukua 40,000, I divide by par value to get the number of shares. Once nikishapata the number of shares, I multiply by the market price per share, which is 15, for me to give me 60,000. The same case with this one. Take 20,000, which is the total value of preference shares. You divide by par value, which is, oh, this one is 10. So maybe your Catherine ndio anasema. So thank you for this. This one is 10. 10. So 20,000. We divide by 10. We get 2,000. 2,000 times 14. We get 28,000. We get 20. Hiyo haikuwa imechange. So we get 28,000. Yes, so it is 28,000, not 14,000. Not 14,000. It is 28,000, not 14,000. I hope we are in agreement. Yes, Catherine, are we in agreement? Then the KD also, the KD, if you look at the KD, the total value of KD is 6 million, which kuna other 3 zeros. So you have to indicate there are other 3 zeros, which is 6 million, but the par value is 1,000. The par value is 1,000. So we divide so that we can get the number of debenture. So the number of debenture, we multiply by the market price, which is 950, for us to get 5,700. So loan, we have not been given any other thing. Loan, we have not been given any other loan. We have not been given any other information. So which means the total value of the loan will remain the same as 10,000. So total, all of them will be able to give you 103,700. From there, take this, we divide by this we divide by this we divide by this we divide by this, so that you can get the weights. So once ukishapata the weights, the formula of getting worker car is very simple. Take the cost, which is the KE, times the weights, times the weight of KE, plus the cost of preference shares, times the weight of preference shares, which is KB, plus the weight of the cost of KD, times the weight of KD, the weight of KD. That is the formula of getting the worker car. So I will take the KE. KE nakumbuka ilikuwa 58.67 times the weight of KE, which is this one, 0.58, plus cost of KB ilikuwa ngapi? 10. Nikikosea mnaniambia, ilikuwa 10 times the weight, which is 0.27, plus the weight of preference shares, the debenture. Hii nao sikumbuki. Hii tulikuwa tumepata ngapi? The cost of debenture. The cost of debenture tulikuwa tumepata ngapi? Hiyo nao sikumbuki. The cost of debenture, angalia the component cost, 14. Yeah, so you take 14.72 times the weight, which is this one, 0.05, plus this one tunaikumbuka. Sikumbuki, 16, we multiply by 0.7. Hiyo ilikuwa ngapi? 16 times 0.7. Ingine ilikuwa 11. So 11.2 times the weight, which is 0.110. So whatever you will get there will give you the component cost, which is the worker car. So the worker car also is the cost of the cost of the return. So examiner can ask you to comment. So tukichukua, hebu tuangalia kama iko kubwa ama iko kidogo. 58.67 times 0.58 plus 10% times. So easy, usichange, usiweke hii una divide na 100, no. Na multiply to the way it is. So usichange easy. So times 0.27 plus 14.7 minus 0.05 plus 11.2 minus 0.1. So we are getting 38.58%. So that is the cost of the worker car. That is the worker car. So you can see it is the below the ordinary shares capital, but it is more than hizi zingine. So that's how to compute the worker car. So ukiangalia hiyo topic tumebakisha tu WMCC, the marginal average, the marginal cost of capital. So unless kuna hata kamera ameamea tu tumalize hiyo swali. So kuna swali? Kuna swali? So hiyo swali nimekuachia mimi, hiyo ni August 2023. So instead of calculating the marginal cost of capital hapo chini, number 4, you do the weighted marginal. So usifanye marginal, so fanya weighted average. So make sure that you do that question. So examiner in hizo APZD atakuwa anakupea hizi ma choices, but the same approach. Also tunaweza angalia ni gani ameuliza, so that you can start calculating. Ilikuwa nimeona most of the question ilikuwa nauliza from that topic. Recently. Wapi? Yeah. So ukiangalia zile za choices, yeah, so kuna April 2024 question what? Question 26. April 2024 question 26. Umeambiwa Kirui Wanyoike Corporation dividend has been growing at the rate of 7% per year over the last 10 years. This rate is expected to continue in future. So camera imepotea, but we can read the question. So you can continue analyzing that question. So ukienda April 2023 question 26. Umeambiwa that Kirui Wanyoike Corporation dividend has been growing at the rate of 7% per year over the last 10 years, and the risk rate is expected to continue in future. The current dividend per share is 23.8. Its required rate of return is 14.2. What is the value of Kirui Wanyoike in shares? So hiyo ameuliza the market value, hajauliza the KE. So kama amekupea the market, so that one you can use, that one is the valuation, which it is the same. Tulisema unaweza interchange your formula ikupe the value of the shares, that inauliza the value, that hiyo ni evaluation. Number 27, if the Kirui Wanyoike price is this one, so that one is just the same na hiyo. So hiyo si ya cost of capital, is somehow the same, but that one is the valuation, but the formula ni the same. Unaweza interchange your formula na upate. Angalia number 46. Umeipata hiyo swali? April 2024. Hizi ni za zile za ziko na choices, April 2024. You can even do that one for me before ulale unitumie answers, Umeambiwa number 46. Kiwara Limited has paid Look at the examiner terms as paid. So you must very keen. You have to underline that term as paid. 10 shilling per share annual dividend on 100 par value of preference shares. The company preference shares has the current market price of 96 shilling per share. The marginal tax rate is 40%. The company plans to maintain its capital structure. Required, the component cost of the shares could be. So I give you 5 minutes. Compute for me that question. Give me the component cost of the preference shares. Give me the component of the preference shares. 5 minutes, hata 3 minutes iko 5 minutes. Mwenye anamaliza haraka unapeana answer na tunamalizia class hapa. Unapeana answer na angalia kama iko sawa. Kama iko sawa, inaweza kuenda kula sapa. Sharon ametoka, ameshamaliza ama bado? Nitamuuliza kwa group. Katrin, nakungoja, wewe ndio nakungoja. Ten point 10.42. Let's confirm that 10.42. The power value. Katrin, that 10.42 for yours is before tax. Tumepewa the marginal tax rate is 40%. The marginal tax rate is 40%. Maybe this one to a tax, but we don't know. But that is the answer. The component cost is 14.2. So this one, we preference shares, we don't multiply by tax. So thank you. That is the answer, 4.2. That is the answer, 4.2. So thank you. We meet next class.